Depreciation, as the term is used in accounting, is the allocation of the cost of a tangible fixed asset to expense in the period in which services are received from the asset. In short, the basic purpose of depreciation is to achieve the matching principle, that is, offset the revenue of an accounting period with the costs of the goods and services being consumed in the effort to generate that revenue. The two major causes of depreciation are physical deterioration and obsolescence. One is physical depreciation and second is obsolescence. Physical deterioration of a plant assets results from use, as well as from exposure to sun, wind, and other climate factors. When a plant asset has been carefully maintained, it is not uncommon for the owner to claim that the asset is as good as new. Such statements are not literally true. Although a good repair policy may greatly lengthen the useful life of a machine, every machine eventually reaches the point at which it must be discarded. In brief, the making of repairs does not lessen the need for recognition of depreciation. The term obsolescence means that process of becoming out of date or obsolete. An airplane, for example, may become obsolete even though it is in excellent physical condition. It becomes obsolete because better planes of superior design and performance have become available. The usefulness of the plant assets inadequate. Inadequacy of a plant asset may necessitate replacement with a larger unit even though the asset is in good physical condition. Obsolescence and inadequacy are often closely associated. Both relate to the opportunity for economical and efficient use of an asset rather than to its physical condition. Most people think depreciation is a process of evaluation. But depreciation is a process of the cost allocation, not a process of valuation. Accounting records do not attempt to show the current market values of plant assets. The market value of the building, for example, may increase during some accounting periods within the building's useful life. The recognition of depreciation expense continues, however, without regard to such temporary increase in market value. Accountants recognize that the building will render useful services only for a limited number of years and that the full cost of the building should be systematically allocated to expense during these years. Accounting entries are the backbone of your accounting concept. Depreciation has an entry as well. The journal entry to record depreciation expense consists of a debit depreciation expense and a credit to accumulated depreciation. The credit portion of the entry removes from the balance sheet that portion of the asset's cost estimated to have been used up during the current period. The debit portion of the entry allocates this expired cost to expense. Separate depreciation expense and accumulated depreciation accounts are maintained for different types of depreciable assets, such as delivery equipment, factory building, and office equipment. These separate accounts help accountants to measure separately the costs of different business activities, such as sales, manufacturing, and administration. Here we will see the effect of depreciation on the statement of cash flows. Depreciation differs from most expenses in that it does not depend upon a cash payment at or near the time the expense is recorded. For this reason, depreciation sometimes is called a non-cash expense. Bear in mind, however, that payment of many years' depreciation expense is made in advance when the plant asset is purchased. Also, when the asset eventually wears out, an even larger cash payment may be required to replace it. Some people mistakenly believe that accumulated depreciation represents a fund of cash being accumulated for the purpose of replacing the plant assets when they wear out. This is a misconception. Accumulated depreciation is not an asset, it is the portion of the assets that already has been allocated to expense. The amount of cash owned by is shown in the asset account, cash and cash equivalents.